so I suddenly felt like, wow, in this hedge fund world, I can actually make a decent living for saying the kind of things out loud that always used to get me like suspended from school, the adult versions of that.
Hi, this is Wendy Lee, co-founder of IB Invest. Welcome to this week's episode of The Investment Office. As always, we're here to discuss the latest in institutional investing, private markets, and alternative assets. We're doing something a little different this week. I'm delighted to welcome our first guest to the show, and I couldn't ask for a more interesting guest, particularly in this market environment. Carson Block is the founder of Muddy Waters, an activist investment firm. Carson and his firm are probably best known for their due diligence reports, which have over the years uncovered a number of publicly listed frauds. I think the most recent count is 11 for the number of delistings that your research reports have led to. Welcome to the show, Carson.
Oh, thanks for having me, Wendy.
Before we dive in, can you share a bit about your background? Before becoming a short seller, you were a lawyer, you were an entrepreneur in China, you co-wrote Doing Business in China for Dummies. How did you go from these experiences to building Muddy Waters?
Well, it's kind of hard to nutshell it, but I will definitely do my best. I did grow up in the investment industry. My father was a sell side analyst, and so he got me exposed to investing very young. And the funny thing is, he literally was known, and I only came to appreciate this as a young adult, but he literally was known as one of the most credulous of management sell side analysts out there. And so, in his worldview or in view of human nature, everybody's good and people aren't going to lie to you. And, I just found investing for myself and working with him on the early 2000s. So I started working with him in actually late 99 and I stopped working with him in '02. And we'd gone through the internet bubble, but the internet bubble is not what had disillusioned me because we avoided all of those stocks. Like we knew it was a bubble. Um, it was that we actually had been lied to by a number of managements of non-internet companies. And one of them, actually, CFO, who my father knew really well, or so he thought, ended up doing prison time for fraud at a company called Rentway. And the crazy thing is, just about a week or two before Rentway imploded, I had developed in a fund manager client for our research, and I set up this meeting in Los Angeles. My father and I attended with the CFO of this company, and the CFO looks my client in the eye and, referring to my father, pointed to him and said, "In the 17 quarters that Bill has covered us, we have never once failed to hit one of his earnings estimates. That's how good a handle we have on the numbers." Literally, it was 1 or 2 weeks later, the stock didn't open, and it's because fraud had been discovered and that guy went to prison. So there were other companies that they weren't adjudicated to be frauds, but they could have been. And this is at the same time. My father and I were covering micro caps and small caps. This is at the same time the largest companies in the world were blowing up in accounting scandals. So that's Enron, WorldCom, Health South, Adelphia. And so it was really disillusioning for me because I had always wanted to be a professional investor. And I just came to this view that really we were prey for financial predators, we being investors. So I went to law school having this amorphous notion that I needed tools to better protect myself against the predators, but I did want to keep investing. Anyway, short of it is, I ended up liking law school a lot more than I thought I would. So I decided to practice law, figuring that would make me a better investor and business person. So I did. Went to China, was with Jones Day China, then stumbled into starting the first self-storage business in mainland China, thinking that was going to be a great idea. And it was actually a pretty awful idea for a number of reasons. But I guess I guess it was the final piece that I needed to really understand the the ease with which illusions can be created by company management. And I stumbled into a publicly traded fraud that was based in China, listed in the US, and I, at that point, had incinerated my life savings in self-storage. So I took $2,000 of put options, and a friend of mine who had helped consult on the project because he knew manufacturing, he also took $2,000. I mean, we both hit up our credit cards for the 2000, bought some put options and published on this company called Orient Paper. And the report concluded that the company was a fraud and raised this money that was stolen. And the report went viral, and my life changed. So literally, in June of 2010, when I published that, I was effectively running this, tiny self-storage business in Shanghai that had one facility and really, no light at the end of the tunnel. Think it was July or August of 2011, right after Sinoforce, Bloomberg named me one of the
Mm-hmm.
50 most influential people in global finance with Ben Bernanke and Christine Lagarde, Warren Buffett, Jamie Dimon. So, I mean, it was so hard not to laugh, at being included in that list, just given where I'd been months earlier. But that's how this was born. And, apologies for it being so circuitous, but as I said, I can't really nutshell it.
No, I think it's a really fascinating background into how you came to be where you are. Although, to your point, you started publishing these research reports publicly, right? You started out by putting it out there, it went viral. You became synonymous with some of these companies that were Chinese companies listed in the ADR market, several of which turned out to be frauds, of which you alluded to, Sinoforest being one of the larger ones that you identified. I think from there, there were probably a few different avenues you could have taken, right? You'd become well known for publishing these diligence reports that were well researched. And I'm curious what led you to continue to share these findings publicly, as opposed to, I think, so often as it happens here on the investment side, when somebody finds an investment edge, when they find a good investment thesis, it really is a bit uncommon to just sort of tell it to the world. I think back then your choice to do so was unusual at the time, maybe more common now, but at the time it was pretty unusual.
Yeah, that's actually, I haven't been asked this question in a long, long time. So we we published Orient paper, and the stock dropped 55% within 24 hours, and just the hate email started coming in because I was entirely open about who I was. I included my email address on the report. And I'm not upset it did, but I didn't think it would have that much of an impact. I didn't expect the report to go viral. And it was, in a way, when I published it, I didn't really know why I didn't have a great reason to publish it. It was more that I didn't have a reason not to publish it. The way I looked at it was, I'd gotten myself, I was kind of out of options in China. I owned a business that really owned me because I couldn't leave because I had several hundred people storing stuff at the facility, and there was no competition in China because it was not a business model that could make money. It turns out that's the only way to stave off competition in China is just to have a really bad business model. Like if it's remotely close to good, you'll have lots of competition. Um, so I felt that, I kind of felt trapped. And at the time in my head, I just had this football analogy, which was, you know what, I'm going to throw the ball as far down the field as I can, kind of a Hail Mary, and see what happens. And the reality is, at that time, I felt that I had nothing to lose. And there is a power in having nothing to lose, or at least in feeling like you have nothing to lose, because you'll take that type of risk. Whereas if the business were kind of viable and I felt like there were options to grow it, good chance I never would have done this. So, things worked out well. Now, after I published it and the stock went down and the company came back, said, oh, this guy, Carson Block, is lying. He and his father tried to extort us for money, and we said no, and this is revenge. then I started getting all of these death threats by email from retail investors who lost money, and some of them named my wife. People were doxing my father's address because I was still living in Shanghai, so they're putting his address in Los Angeles online and saying, "Let's go down there and tell this guy what we think of his son." Um, I was freaked out. I mean, it was, Jim Cramer, whom I'd never met. He's on CNBC and he starts talking about this and he's like, I think, this guy's the fraud and, me. And I was not prepared. And so I had to leave China at that point just to get my head clear. So my wife and I, we just got out, went to LA, and while there, I started getting outreach from a lot of institutional investors and like serious people, serious
Mm-hmm.
funds. And, they were saying, hey, great job. This is just the tip of the iceberg. Look at this one, look at that one. But some of these outreaches were from funds that were willing to pay for subscription research. But the provision or the caveat was I wouldn't be able to publish openly.
Mm-hmm.
There was one large fund that wanted to be the exclusive client, and when I gamed it out, and again, remember at that moment in time, like I was basically in debt. I think I had borrowed another couple $100,000 from my father with no end in sight. And so financially, when I sat back, I was like thinking about it, I could probably make a million or more a year on doing the subscription research. But I mean, what good is it to tell people about these frauds if nobody's going to expose these frauds? Like,
Mm-hmm.
does that really make sense? And does that feel good? Like, I don't want to be sitting on these secrets. And
Yeah.
just at the end of the day, it didn't really feel like it was me to do this research for one or small, 1 to 5 clients and not expose the frauds. And look, I will also say at this point, there was also a therapeutic aspect for me doing this. I mean, having been through the wars in China, the business
Mm-hmm.
wars, and, having dealt with what I call business assassins, you know, I, I, I had a really, I was at that point kind of depressed about China because I had a lot of Chinese friends, like good people, and I just viewed it as a place where being good and playing by the rules is not rewarded, and that you have these people who view themselves as being above the law, who are constantly taking advantage of everybody else. And and I'd stood my ground against some of these people before, and I mean, I can't say I won, but I didn't lose. But suddenly I felt like I had this power, like, you guys have messed up. You're trying to play these games in my sandbox. Like that's a mistake. And so there was this therapeutic element I felt if I could continue exposing these frauds. So the question was, okay, if I assume that I'm going to get sued, some rate, and if I assume that I have to talk to regulators regularly because, I don't know if they'll know what to make of this business model, can I generate enough revenue to cover those costs, put food on the table, and also make me feel like it's worth the stress? And there was no way of knowing for certain that I could, but I got the sense that I could. And so I decided within a few weeks of having published on Orient Papers, so this is the summer of 2010, I decided, no, I'm not going to go the subscription route. I'm going to continue to publish openly. I'm going to, raise some money somehow, and trade that capital, like basically try to turn it into prop capital, and make money that way. So that's how the business developed.
And I just want to point out, because I think this is for many folks such a counterintuitive choice, right? You had this certainty, you had, to your point, large institutional investors who were interested in working with you. You had a almost certain income stream compared to, you said, no, I would rather deal with publishing my research publicly. All of the attention that comes with that, the positive and the negative, the SEC attention, the potential lawsuits. You had already had your personal information shared online, and you chose that path instead. And I have to admit, I have a real soft spot for short sellers. I always have. I feel like folks who are determined to uncover these types of companies that are perhaps acting either fraudulently or inflating financial numbers, you're just built differently because it is not the most obvious way to make money. It's certainly not the most painless way to make money, right? And so you chose this path. You chose this path of doing this, not just being a short seller, but doing it so publicly. Um, and so I think, you know, to the extent that we can talk a little bit more about moving and going from publishing these reports, taking some prop capital, how did you then move from that toward setting up a firm? Because to your point, like that wasn't necessarily the ambition at the outset, or perhaps it was, but it sounds like you just had this innate drive where you wanted to publish this information. You felt like the world deserved to know. You felt driven to uncover these types of companies, and you thought you could round up some prop capital. But was the ambition always to create what Muddy Waters is today, which is activist investment firm?
Sure. Well, since we're going kind of deep, I will add a little bit to that. The other thing was that I felt really early after making that decision that I had actually found my true calling because I was always somebody who had gotten in a lot of trouble in elementary through high school. I would always say unpopular things to teachers. I mean, a lot of times I was not right, but there were times I was right. And and saying things that were unpopular, generally just, it had not proven to be a a ticket to success in life. And so I was looking at this and I was just enamored with, and this is a little bit after the financial crisis. And by the way, I'd been engrossed by the books. I'd already been engrossed by the books on the financial crisis, like the Lehman collapse, the Bear collapse,
Mm-hmm.
AIG, book that Bethany McLean wrote. So I'd read them all. I mean, I loved getting into just the dysfunction, like the very human dysfunction at the heart of these organizations. Just really like understanding how the sausage is made. And so I suddenly felt like, wow, in this hedge fund world, I can actually make a decent living for saying the kind of things out loud that always used to get me like suspended from school, the adult versions of that. So there was part of this that was, as you were saying, were built differently. For me, that was basically custom built. So I wanted to continue doing that. And but pretty quickly I realized that I mean, the be all end all of short selling is getting access to stock borrow. And so
Mm-hmm.
if you have a retail account, you're basically last in line. So I made an arrangement with a hedge fund where they were my balance sheet provider and they put on the trades and paid me a portion of the profit. But I pretty quickly decided that I wanted autonomy, that I wanted to have my own fund, but it needed to be a fund because I needed to have access to institutional borrow. And what I pretty quickly ran into, I mean, first of all, the costs of setting up. I mean, I was initially thinking like, hey, like $10 million, right? Like the
Mm-hmm.
principal at this hedge fund, he'll easily give me 10 million. I maybe scrounge a few million from somebody else. I first start looking at what it costs to set up a Cayman fund, and like, well, that's for 10 million. That's kind of a chunk, but okay. I started going down that route, but then the primes that have the great access to borrow, they're not going to talk to you if you've got 10 million in AUM. And plus, also what I was doing, and not to my surprise, but it became pretty unpopular with these investment banks, just because they saw it as antithetical to their core business, which is, raising money on behalf of corporates. So the big pretty primes wouldn't talk to me. Then the introducing primes, the ones that can intermediate between
Mm-hmm.
smaller funds and the big pretty primes, they talked to me, but then the big pretty primes told them, no, we're not going to deal with this guy. So I was effectively forced to maintain that balance sheet relationship beyond that. So to be clear, I already wanted to control, you know, outside capital, right? I wanted to have my own fund, but it was just too small and I was too new and too edgy. I was talking to Credit Suisse in 2013 about priming for us, and we're at the goal line, and I was in the delivery room, or where my wife was about to give birth to my first kid in several hours. And I got a call from the West Coast prime sales guy, and he's like, "Ah, man, I've never had this happen. I'm really sorry, but yeah, there's something called a reputation risk committee here." And yeah, they said we can't prime for you. So that fell apart in 2013. So I was kind of resigned to, all right, we've got our interactive brokers account, and it's like, decent size IB account for IB accounts, I guess. Look, an IB is great as a retail product, but I was just resigned to my fate for a while, thinking that I would eventually say, okay, I got to get out there and really try to market and raise a fund. When I spoke at the Iverson London conference in November of 2014, and um, this Ivy League endowment, their top two people were in the audience, and they were at the speakers dinner afterward, and they made a point of sitting next to me, and they said, "Look, if we gave you $100 million, would you be open to managing it?" And I had to sit there and kind of count in my head, to make sure I didn't answer yes, of course, too quickly. So I had an institutional amount of money that was offered to me. I didn't have to do a moment of marketing in order to get that. And that was when I was able to start the conversation with primes and I guess look serious enough that some of them onboarded us, despite the fact that, like Credit Suisse would not.
So now you have the capital, you have your own fund. There's a huge difference, though, between having some ideas, having some prop capital, and being able to make some good trades and actually managing a portfolio, right? Like there is a step function change that occurs between making some good choices in individual stock selection and then constructing an entire portfolio, particularly if, as I imagine was the mandate at the time, this is a portfolio where you are building a number of dedicated short positions. And so you're thinking about how do you manage that risk in this single dedicated strategy. And so I think so often where I have seen a number of managers that have taken, I think, a lot of risk off on the short side of the portfolio in recent years. It's been a very difficult market to short in general. But even before we sort of get into this, talking about the long bull run environment, which we've actually been shorting for the duration of Muddy Waters as an investment firm, um, I want to just talk through how you approached that initial pool of capital where you knew that you had good ideas, you knew you could do good research, but you didn't yet know if you could manage a portfolio or build a portfolio around this investment strategy.
Yeah, so it actually was a very good interim step. What they had in mind, it was not an unconditional, here's $100 million, go make us some money. They initially wanted it to be a managed account, but for various reasons that wouldn't work. I mean, we needed to be multi-prime. I think they just had one prime. And also their prime was kind of sensitive to the idea of putting on these short activist trades. So we had to have an entity outside of that endowment that we managed. So what they said was, okay, look, here's the deal. When you have a trade idea, you're going to run it by us, and we're gonna kick it around with you, make sure there's no issue, and then we'll send you the money for the trade. And as you realize profits, we want you to send those back. So it was training wheels, I would say. I had to go through the entire rigmarole of getting connected to prime brokers and the ISDA process and understanding how that worked. And initially that was a real deficit that I had in the business because a lot of your hedge fund launches are from people who've at least sat inside a hedge fund, which I had never done. So, looking back, I think it was great that I had that interim step. So we launched that in I think November of 2015, and we got ready to launch a pooled vehicle. So we launched the pooled vehicle in August of 2016. So by then I had already somewhat hit my stride. And with the pooled vehicle, the mandate gave me a little bit more latitude in terms of how we were running risk and an ongoing basis. And I think for me, and this goes back to my career on the long side. A lot of people might be surprised to hear me characterize myself this way, but I'm actually very risk averse. So when I'd been working with my father, he and I constantly had these um, debates in which I was constantly saying like, yeah, the stock has run too much. I'm going to sell it. I think you should sell it too. And and it's really funny. I mean, he told me when I decided to leave and go to law school, he's like, yeah, look, I think philosophically we're very different. You're much more risk averse than I am. And, here I am as a short seller, an activist short seller, I'm attract, lawsuits, investigations. We're short. Sometimes we're, really big short positions. Um, so there are ways in which I'm risk averse, but when I feel like I have real edge, then I look to capitalize on that. So I look at it all as calculated risk, or taking calculated risks. And as I got older, I learned which pitches are the fat ones and to swing at them. I mean, when I first saw Sino Forest, I'm glad that my pattern recognition by that point was well enough honed that I knew that this was truly a fat pitch at which I should swing. And it was transformational to my career, my personal finances. So managing money at that point when we raised the pooled vehicle, it had, like I said, sort of the training wheels on with the fund of one, that was kind of closely watched over by the client. Um, and I combine that with, just being very risk averse.
I want to actually hone on this because I don't think it's surprising you're risk averse, right? Or perhaps it isn't surprising to me to hear that because you have managed to survive as a short seller in this market. As I had earlier mentioned, we have been, I'm sure everybody listening is well aware, we have been in a pretty significant bull market for over a decade at this point. In order to survive as primarily a short seller in this market, I have to imagine that you are highly conscious of risk management. And so I actually want to, there are a couple of things that you mentioned I want to double click on, but maybe the first is let's talk about this risk management that you are innately more risk averse, but purely just from a survival standpoint as a short seller in this type of market where you mentioned you have to deal with short squeezes where you are constantly facing the risk of lawsuits and perhaps inquiries from the SEC, right? There's no shortage of potential landmines for you to step on. And so I'd love to maybe dive a little bit more into how you do think about risk.
Sure. Well, those are a few different risks that you just outlined. So, my view, risk management starts all the way at basically project or target selection. So, if we look at something and it's crowded, we're not going to pursue it unless we think that the crowding is going to ease. Why? Because if it's crowded, you're at high risk of a short squeeze. So we want something where borrow is generally GC, easily available, that's not
What's your
crowded.
threshold? What do you consider a threshold for crowded? What do you consider a threshold for easy borrow?
Well, okay. So when you check borrow, stocks are either listed as GC, general collateral, or they're on the hard to borrow list and they have higher rates. Now, sometimes we will go into the hard to borrow, but when we're talking to the primes, if they're saying like, yeah, look, I can maybe scrape together, blank number of shares, that's hard to borrow, or that's genuinely, hard to borrow at risk of squeeze. If it's, yeah, we've got maybe $20 million, right now that we can show you, and it's at 9%. That's moderately hard to borrow. So that's in the zone in which we'll think about it. And then we start thinking about the short interest or stock on loan as a percentage of the float. But then you also have to X out any of the passive holders because that's not real float. So that's how we think about how crowded it is. I mean, fortunately, with us, because of our, where we're able to play, in terms of market cap and, more sophisticated research than a lot of other short activists, because we just have the talent, in terms of the people on board and, former auditors, et cetera. A lot of those names are not highly crowded short names. And, they're generally not as squeezy. But risk management starts with, is it worth our while looking at this? And another component there is the trade going to be big enough? I've got, several other friends who are activist short sellers, and every now and then I'll kind of have it out with them, after they've published on something where I'll say, look, that was probably a $5 million trade, right? Yeah, about that. Why would you do that? Well, it was, like clear fraud, or, like thesis was really easy to prove. Right. Okay. But, you have to look at it this way. And I think a lot of them do acknowledge this, that you will get sued, one out of every X times. Okay. And your costs of getting rid of the lawsuit are somewhere between less expensive counsel, $250,000, more expensive counsel, $500,000. So what are you going to make day one on that trade? If you make basically, 10%, which is probably going to be, the bulk of what you're going to make on the trade, on that report, all right, that's $500,000. And you're going to, risk losing half of it to legal fees. Like, that's just a bad idea. So risk management starts with, is this a smart company for me to look at? Then risk management continues throughout the research process. And one of the things that's so critical is having the culture internally where people will speak up and where they're focused on getting it right, not making money. Like, everybody wants to make money, they've got to be commercial, but it has to be this right balance here where, like, the really wrong person to hire is the person who thinks like, oh, if we make money on this, I'll get a bigger bonus. And, if this ends up kind of like, imploding the firm, like, I'll just move on somewhere else. Because I've seen people in this game hire that type of person, and to do work that they couldn't do, say if it was specialized like China or accounting,
Mm-hmm.
research. And if you have the wrong people, or you don't have a really strong culture of constant internal debate and challenging each other, their assumptions openly, then you're failing on the risk management, front. So that's step two, is the research process, which is very much informed by culture. The Sinoforce report brought in a new model for us doing research, because it was at that time that I was no longer doing the majority of the primary research, right? Because that was a large, complex project. And from there, we went on mostly to large complex projects, and my business became more complex. So I became, in a way, sort of the general contractor on top of the subcontractors. So for me, the critical skill is making sure that I'm asking all the right questions, I'm seeing all the holes in the argument. And, honestly, I've viewed my job for years as principally being a risk manager, but this is in the research
Mm-hmm.
process. It's also, of course, in how we trade things, the sizing, the hedging, when we take the positions off. I mean, in terms of exiting trades, there have been some, well-known situations in short selling in which you had somebody hang on to a position, either, out of pride, like, oh, I'm going to keep this till it's a zero. That's how convicted I am. And, nobody comes around and pins a medal on your chest, if you do that, especially when you lose money. Um, I mean, I've seen a number of people with that syndrome. Well, if you really
Mm-hmm.
believe in it, you got to what, like, go down with the ship? No, I'm sorry. I mean, these are client funds, especially. Like, I wouldn't do that with my own money. I'm definitely not going to do that with client money. Then you get the people who I think take a really penny wise, pound foolish approach. Well, I want to hang on to this because the stock's down a lot, and if we don't exit the position, then we don't have a realized a gain, and we don't have a taxable event. My investors will appreciate it. Yeah, right. Like that was GameStop, right? Okay. I don't think there's honor in hanging on to one of these positions too long. So again, with my risk aversion, I would rather be out too early than to
Hmm.
hang on to the bitter end. So, and like Wirecard is a great example of this. I mean, we weren't involved in Wirecard, but you saw so many people short that stock over the years,
Oh
and it
yeah.
just went up. And only one short seller in public is known to have gotten it right. He came in like just as the stock was about to crater, right? That was the smart way to play it. Basically, it had fought off all these critics for years, and the German government had helped it. And there was one report left that would basically, tell the truth. And that's when he said, okay, like this is the time. If you're ever going to put on the wire card short, this is the time to do it. And it was timed beautifully. So it's a bit of a digression, but the point is, I think, discretion is definitely the better part of valor when it comes to short selling.
So I really appreciate this digression because I think this is a very important point. It's such an obvious thing for me to say, but there's obviously many differences between investing as a primarily long investor and trying to make absolute returns from short investments, not least of which is time is just not your friend, right? As a short seller, time is really not your friend, and getting the timing of positions, whether it is the initial putting the position on, taking it off, everything in between, it is so critical. And I think that is something that is more, I don't know, perhaps more art than science. But you have the ability, given the business that you have built, given the way that you started in publishing your reports publicly, which I should mention if anyone's ever interested, all of your reports are available on Muddy Waters Re on your website. And you made that choice, and I don't know if you could have foreseen the ability to now create your own catalysts as a consequence of that, right? And I don't know, you could have seen 20 steps forward to the business that you've built today,
No,
right?
no, 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 definitely not. Especially when you go back to that decision to publish the first report on Orient paper. There's no way I could have foreseen this, but there was one thing that you know, I didn't mention this earlier, but there was one other thing that came up in the process of considering whether to publish openly or do subscription. That one fund that basically wanted to be the exclusive customer, when I said, yeah, you know what, and I'll look for things outside of China as well, and because they were going to pay on an per idea basis, and the PM said, well, no, no, we just want you, just want the China ideas from you, and like I always felt that I really internalized that because that, I knew what he was saying, and I knew a lot of other people were thinking the same thing, which is you're a one-trick pony, you're a China guy. And, I knew I wasn't. I'd been investing since I was a kid, and I felt like I could adapt to numerous different markets and situations. So yeah, that was the one thing where I couldn't foresee what this business would become, but I definitely foresaw that I was not going to be stuck in the China box.
Fair enough. Fair enough. Um, I want to go back to something that you said earlier, and then I'll move off of this. But you had alluded to over the years, you've become very good at spotting the fat pitches. So, curious if you could share what do they look like to you? How do you think about them? What are some of the markers of where you really lean in versus you don't?
Well, I mean, at the end of the day, what we're looking for is, I mean, is a disconnect between market perception created by management usually, so misperception and reality. Now, the funny thing is, I've found over the years that our bread and butter is in doing exposés on companies that the market thinks have some hair, has some hair on them. So kind of okay-ish companies, but are actually really problematic. Um, one thing that generally hasn't worked in activist short selling is a company that's, quote, priced for perfection that the market thinks very highly of, and you show, no, doesn't deserve to be, or you try to show, no, it doesn't deserve to be priced for perfection. It's really a mediocre company with a reasonable amount of hair, and it should re-rate. That type of thesis really doesn't work. So, if you're rating companies on a scale of 1 to 5, five being perfection and one being garbage, um, trying to show that a five is really a three is generally not a good way to make money as an activist short versus trying to show that a three is actually a one.
Mm,
Now, your fattest pitches, your sinoforests, are the fives to ones. Now those are pretty rare, right? When you get that. So maybe NMC Health, which was a FTSE 100 company that we exposed in 2019.
mm,
That wasn't a five. Maybe that was a four. That we exposed as a one. I mean, it actually was that was really, especially in America, because it was a UK-based company with operations in the Middle East. It went under the radar, but that thing
mhm,
was like a massive fraud. I mean, you know, that was like as big as, if not bigger, fraud than Sinoforest was actually. So anyway, we're usually out there looking for the threes that are actually ones. Although always waiting for, fortune to smile on us with a five that's a one. But anyway, when we're talking about these companies that are not perceived as fantastic, but if we see things that are kind of obvious that speak to being promotional, where management
mm,
just makes these bold pronouncements consistently, and and maybe this also touches on companies that are maybe category four, makes these bold pronouncements, and just to us, I mean, look, I think all of us, at my firm are pretty attuned to, oh, that sounds like hype and exaggeration. And I think to some extent that's par for the course now. So you just have to look at transcripts or look at the narrative around the company to really try to figure out, is this excessive or not? I mean, again, that bar for what's excessive goes up, more or less every year, or has gone up. But, whatever. There are companies that we think clear it. And so then we try to scratch the surface. And you ask the question, what's management's financial incentive here? So you look at the comp pacture, or the comp structure. Oh, well, the comp is basically determined based on this metric. And of course, that's the metric that they're always touting. Okay, well, let's deconstruct that, and it's of course some non-GAAP metric. Well, what adjustments do they make? Okay, well, let's look at the things that are adjusted out or adjusted in, and scratch the surface and what are they really? And then, sometimes you're like, oh, that's so bad. Like, you're excluding that. Like, oh my God, well, what's that tied to? Let's look at the assets, that you're excluding, you're excluding the depreciation of these assets. And like, oh my God, these things are horrific and they massively overpaid for them. Well, okay, that's relevant. I think that's material. Let's tell the market about that. So that's on the equity side. Every now and then, and I'd say I almost like these better, maybe just because it's a little different, but every now and then you get the company that's got debt, right? And it's triple B minus company. So they're just trying to cling to that IG rating. So the incentive isn't pump the stock, get share grants and dump my stock. Like that's more the typical cycle that we're dealing with the equity people. But when you look at the triple B minus category, and those are often those are true threes, but it's what sort of games are they playing to to make sure they don't fall below investment grade.
Hmm.
Because if you have a company where cost of funding is critical, yeah, like you'll see that. And so one of my favorite shorts, from the past in that category was a company called Noble Group, which was based in Hong Kong, listed in Singapore, that was a commodity trader. And of course, being a commodity trader, there are lots of ways they can turn the dials on things. And they did things that were not illegal, but were just it's amazing they're legal in terms of the models that they spun to create these mark to model, consistent fair
Mm,
value gain profits period after period. And when you really got into it, then you learned that these things were just entirely, I mean, like, you can't technically call them lies, but unless you can find emails between them, in which they're, saying they disbelieve the assumptions, but you'd have to have a very, very, very skewed view of the markets and your business to use some of these assumptions.
mm.
And of course they went bankrupt ultimately.
Very interesting. Super helpful. You've been doing this long enough in a market which, repeatedly referred to as being a challenging enough market for anybody who is primarily looking at short positions. What are some of the lessons learned over the years? What is your? I
Oh
know there's
man.
got to be. I'm guessing
Yeah.
there are probably a few, but what are some of the key lessons learned that as you continue to constantly refine your process and look to be a better investor?
Well, okay, the market is constantly evolving. So if you don't evolve with the market, then especially the rate at which it evolves now, then even if you have a successful business today, good chance you're not going to be that successful in a few years from now. So you have to be flexible. And look, we've done that with our business. I mean, we're not only short activists, we have a long-oriented resource product. We've got systematic long strategy that we've run. It's quantitative momentum strategy. But even within short activism, you have to be flexible. You have to realize that the bar for what people care about has gone consistently higher every year, just because you know the markets have gone up. I mean, a lot of that's structural or almost mechanical that's caused that, but um, you have to be able to respond to that. And one of the other things as an activist short seller that's been a reality, and I think we've generally been on the forefront of innovating, in this business, but especially on the communication side, the human attention span has shrunk tremendously from 2010 when I started doing this. It's due to the phones we have in our pocket. So I used to muse to myself that, oh, nobody reads past this, like the third page. I mean, then it became the third paragraph, and today it's, probably not even the third sentence. So I've had to adapt the way that I present our theses. We've started doing a lot of stuff in video. Social media obviously has become more important. Being able to write something that fits in the box, 280 characters, says what you want it to say. Um, so yeah, I mean, the being adaptable is key. And I don't know, maybe that sounds cliche, but I've just seen a lot of people who haven't adapted. And I think the flip side of that, well, maybe yeah, flip side of that coin is to not be religious about anything. I mean, there's some very, very smart people who've been, traditional short sellers and you know, they've become religious what they've done for a long time. They have not changed, they've not adapted, and they see the world. Maybe the biggest lesson is this, and it really touches on both of the things that I'm saying. Is that you need to see the world the way it is, not the way that it should be. And I've I used to fall victim to that myself, and maybe sometimes I still do, where I see the way the world should be, and I can make this impassioned argument about, you know, why a given company needs to be exposed. But lots of companies that should be exposed or, quote, need to be exposed, it's not going to matter to the long side investors. And that's the sad reality of the world that we live in. And I think a lot of people who've been short sellers have had a hard time adapting to that reality that, what you care about and what you think is right and what you think is wrong doesn't matter to the market. So you really have to understand what matters to the market and be good at that. And that's a challenge. Like there's
Mm,
sometimes we get that entirely wrong. We'll spend a lot of time and resources researching something, we'll publish it, and the market will say, yeah, and we don't care. So I think that's the hardest part. And that really is more art than science. But again, from a mentality perspective, there are a number of people who I think just haven't admitted that to themselves, and they'd rather be, right than make money. And,
mm,
at the end of the day, you got to treat it like a business.
hmm Um, I want to just double click on something that you referred to as part of this, right? Recognizing the world as it is, as opposed to the way you feel it should be and evolving along with the times. You referred to the way that you have also evolved in how you approach media and how you approach sharing the research that you publish. And in having conversations with you, you always strike me as someone who's very thoughtful, right? You mentioned yourself, you tend to be more risk averse, and yet in the ways in which you approach your storytelling in the more public spheres in certain parts of media, I think there's this line that you have to draw where you still need to be able to capture attention in order to some degree, manufacture the catalysts that are core to your strategy, right? But there is a fine line there because at the same time, you're also a serious investor. And so how do you think about that distinction? How do you think about navigating that?
Well, okay, that part, and maybe I'm underestimating the challenge that it presents. Maybe I don't walk the line well, but that part I think is reasonably easy. I mean, there's innumerable volume of short reports where, as I put it, the authors are screaming from the mountaintops, "This is the worst company ever! Oh my God!" And no, it's not. I mean, I think by now, especially, and look, in my early days of doing this, I was genuinely amazed by the discoveries, but in some cases, and then, I eventually became inured to it. And I think a lot of the market is inured to that. And they're inured to these calls that this is the worst thing ever. And, um, so I think my sense is that when people write that way or they communicate that way, they're exaggerating. And I think they know they're exaggerating. And I think you just have to be honest. Now, that said, my language has always been sharp, right? And unfiltered, because if you speak with me in real life, um, like that's how I actually talk. So if I think something is bullshit, like I just say, I say it the same way that I write it. So the way I express my thoughts publicly is fairly similar, maybe somewhat less profanity but it's fairly similar to how I express them privately. So I think that you have to be, you have to be honest in your communications and focus and really focus people on what's important and not like, oh my God, this is so egregious. Like, every CEO is dumping hundreds of millions of dollars of stock today on the back of pumping the stock. It's worth mentioning that, but it's not worth like jumping up and down and screaming about. I think it is a valid data point, but yeah, they're doing this because this is the payoff. But focus on what it is that they're doing and how they're misleading you or how they're misleading investors. Like that's what you have to do from a communication perspective.
Hmm. Yeah. I have two final questions. One is, if you have one, what is your favorite position you've ever put on?
My favorite position I've ever put on is probably one that we put on that we were about to publish on, but it fell apart anyway. And then we published on it. So that was a stock called Burford Capital, litigation finance firm that was at that time listed only in the UK, and it was pretty yeah it was pretty crazy. We published on it in August of 2019, and um, we'd put on a bunch of risk, and we are going to publish the next morning London time, and I was in San Francisco, and I tweeted tomorrow morning 8 a.m. London time, we're going to release a new report. So I didn't specifically state it was London, but I mean, the inference was clear. Well, automatically four stocks crashed, and one of them was Burford. And Burford closed down that day, I think almost 20%. Another one that crashed was NMC Health. So that was one that we would later come to short in December of that year. So maybe it wasn't a four. NMC was weird, like it. But so it was Burford. Sorry, it was three stocks that crashed: Burford, NMC, and Rolls-Royce, which to this day I can't figure that one out. But yeah, and then we published on Burford the next day, and it went down even more. I mean, it went down maybe another 30% that day. So that one was just interesting because it was so instructive. Like you obviously had all these people who were long, who felt that it was, like knew that there was something wrong with the company, right? So like it was a three, and the moment I tweeted out that we were doing something in London, everybody jumped off the train, right, thinking, this might be going over the cliff here. And it's just, it's kind of really strange investor behavior, right? That they're just trying to ride it as far and as fast as they could, knowing that it was a really flawed company. So that one I think was just really interesting how we had those two down legs. And then also the ensuing back and forth afterward. I actually kind of enjoyed it. Like it got really personal, the way they went after me. But I mean, the CFO was the CEO's wife, and so not a lot of people knew that. And so it was just kind of like, okay, but you guys, everything that runs through your income statement is the product of a mark to a model, and your wife's the CFO. So I mean, like, come on, like this isn't like best practices for corporate oh, and it turns out we got information on their board of director meetings, and it was really like this great luxury adventure travel club. Like that's what their board was, where they like the spouses who'd come along and posted all these photos of them drinking like really nice wine in these exotic spots all around the world for their board meetings. So Burford, it was an interesting one. It was fun. And I don't know if they didn't get delisted. I think the big truth that we exposed there was that pretty much their whole book was tied to one claim that they have against the Argentine government over the expropriation of joint venture stake in YPF, their large
Hmm.
ONG producer. So, to this day, Burford is out there like, you know, hoping that, Milei authorizes, payment, and it's if they get it, like, Burford's done all right, but we're just, they were not at that time honest in presenting how much of that balance sheet value and how much of the fair value gains they had taken were related to that one case. And it's kind of binary. Like Argentina is either going to, continue to zero them on it or they'll get paid. And I think the former, the zeroing is more likely. I mean,
Mm,
this is Argentina, but remains to be seen.
yeah. Yeah. Okay, last one, which I saved for last because we could have probably spent an hour on this, and so, but I couldn't not ask, given the timeliness of it. I'm sure you have seen the Citrini report from yesterday that came out and sent a lot of folks into a tizzy about AI related impacts on business models. Don't have to go in depth. You don't have to, share everything. But I would just love your take on it.
That's a hard one not to go in depth on. But
You can if you want. There was a reason I saved it for last because I figured this could take up the entire conversation, but I couldn't not ask.
okay, so it's interesting because I was, I think I still will put out something written on our view here on AI and what it's going to do in terms of markets. Can't see anything with certainty, but I do see a very real possibility that at least 15% of knowledge workers lose their jobs within 3 years. And and that can be conservative. And like very in recent data points, since I've formulated this thesis, actually suggest that could be conservative. The question that everybody been asking for so long is, oh, is AI a bubble? And I didn't get those questions since the stock sold off some, but I think the question that we really need to be asking is, um, if this technology is not hype, well, what then? Like what's that going to do? And if we see anything like what I'm talking about, what I fear, and I'm not banging the table with complete conviction saying this is what's happening, this will happen, but I think it's definitely a non-negligible chance. And as I said, it could be a lot more profound than just 15%, and it could occur, on a faster time frame than 3 years. I mean, that's going to have profound implications for everything. So, what we've been working on, and I've worked more hours the past couple weeks than I have in a long time. Is we're protecting the book, right? I mean, we run market neutral, we're short long, we do well in down markets, but we are putting on, and we have put on and are continuing to put on trades that we think are highly convex, asymmetric trades that we think will generate, significant profits in the event that bad things really start to happen. And then talking with other investors with whom we speak, I mean, I mean, they're all thinking the same thing, and everybody's grappling with, well, how do you position? And there are differing views on that, but we have our views, and basically, look, if nothing comes to pass, our core business, it's probably, fine, and we've done well, and hopefully we put up, continue to put up numbers that we put up. If it comes to pass, I think our investors will be happy from the perspective of, they'll have capitalized on it, and I don't think it'd be quite like John Paulson numbers, by any means, but could be reasonably profound numbers. But then we all have to, answer some really uncomfortable questions about, like, what society look like and what are our kids, I mean, yeah, I've had the strange luck of the past few days having to speak with some kids, right? Like somebody who's in college and wants to go into finance, he's a freshman. Somebody who's a highly motivated high schooler, wants to be a lawyer. And so I mean, I've really had these in-depth conversations with them, and I don't even know if you should go to college. Like, I don't know. In the short to medium term, if this happens, we will be, we as a firm, our clients, at least with what they have with us, I think we'll do well. But I think we all have some really big, some really big questions, and I have had a number of sleepless nights recently over this one. So just to be totally blunt about that.
Well, that is a very cheerful note to end our conversation on.
Don't ever come to me for the good news. Like if you're coming to me looking for good news, you already have your answer, okay? Like it's bad.
Um, I just want to say thank you so much, Carson, for joining us and for sharing as much as you shared today. Thanks for taking the time, and it was such a pleasure to have you on today.
All right. Thanks, Wendy. Enjoyed it.
The investment office is presented by Ivy Invest Corporation. Ivy Invest Corporation serves as the advisor for the Institutional Investment Strategy Fund, a closed-end interval fund. The fund is designed for long-term investments and is not intended as a complete investment program. An investment in the fund may not be suitable for you if you will need the money you invest within a specified time frame. Shares in the fund are illiquid and can be sold by shareholders only in the quarterly repurchase program of the fund, which allows for up to 5% of the fund's outstanding shares at NAV to be redeemed each quarter. Before investing, you should carefully consider the fund's investment objective, risks, charges, and expenses. This and other information is in the prospectus and summary prospectus, a copy of which may be obtained by visiting fund documents at ivyinvest.co. Please read the prospectus carefully before investing.